Well, hello everyone. Thanks for joining us this afternoon. We're using this web presentation format to make it a little bit easier to view the presentation materials, but don't hesitate to just raise your hand and I'll allow you to talk because I'm sure everyone's going to benefit from questions from the audience throughout the course of our discussion. This will be recorded for colleagues that couldn't make it. We'll put it up on the website later today. So this presentation is about our municipal recovery, or our municipal climate recovery fund, with that we announced, I guess, going on a week and a half ago, alongside the governor and the state treasurer, and as well as Ted Brady from VLCT. The purpose of what we're calling the MCRF is to provide municipal budgetary relief in the flood recovery effort by lowering the cost of borrowing to bridge FEMA reimbursement or insurance proceeds or many costs that may be unexpected due to either revenue losses or just simply the expenses of cleaning up and repairing things post flood. Great thank you to the Treasurer's Office as well as the governor for helping to capitalize this program through a loan in the 10% for Vermont program. This allows us cost of capital that we're going to be passing along without alteration of a blended rate of 1.3%, which is obviously quite advantageous in the current interest rate environment. And then we'll talk about this in a bit, but therefore a number of borrowers, VLCT Passive will be further assisting them by subsidizing the interest rate to effectively a near zero rate. And they've committed $1 million of funding for this subsidy. And eligible communities that are eligible for that are listed on our website via a memo that VLCT has provided, and they will also be integrated into the application for this program, where you can select your community if you are eligible. If you're not on the list in the application, then you're not eligible. But I think the good thing is you'll still be benefiting from a very low interest rate. So to get into the requirements of the program, go through the terms first, and then what we expect the statutory mechanism for most communities to look like in terms of authorizing the loans. The minimum amount is $100,000, although, if you're less than that and it's very meaningful for your community, please let us know. The intent is to help as many communities as possible, but we figured that'd be a decent sized threshold, given that the intent is really to reimburse existing bank loans or existing interfund loans, and that's a meaningful number to provide reimbursement. The term of the loan is 7 years. This is born out of our experience in Irene, or following Irene, when really as late as 2020, the bond bank in our annual monitoring effort was observing communities that still had unreimbursed expenses from FEMA. And so we want to provide a sufficiently long runway for all of you, given that there may be unexpected things that arise in the reimbursement process or in the process of simply rebuilding. The amortization is 5 years. So in other words, there'll be 2 years interest only, which is when, we'd expect the majority of insurance or FEMA reimbursements to occur. So, no sense in amortizing principal when you expect to pay the full amount off during those first 24 months. As I mentioned before, the interest rate is 1.3%. We'll have closing costs of $1,000, although we are not taking, we are essentially not paying ourselves for this work. We do bear some fairly significant legal costs, and so we're trying to recapture those. Those can be integrated into the loan amounts themselves. The payment dates are semi-annual, December 1st and June 1st. You can prepay at any point with no penalty. And in fact, if you receive insurance proceeds or FEMA reimbursements, we expect and you will covenant to use those funds to pay off the loan as soon as possible. And as I mentioned before, the expected flow of funds is that this would primarily be used to pay off bank loans that have been taken out for interim lending or interfund loans that may exist in whatever form that is. And then, but we we understand that there are potentially large costs to single vendors. And so we'll explore direct expense reimbursement upon request. So just be sure to note that in your application during the narrative segment of the application. Eligible uses for the funding, costs that are eligible for FEMA Public Assistance Grant funding, costs expected to be paid from insurance payouts, own source revenue loss up to 10% of the prior fiscal year, and then the initial planning and initial rebuilding of flood impacted infrastructure. This is not intended to be a construction loan program. For that, you would be turning to either the, if it's water or wastewater infrastructure, turning to the SRF program, or if it's more facilities in nature or even roads, looking at the bond bank's pooled loan program. Those would be the appropriate mechanisms for long-term capital. This is really meant to be an interim program, but obviously you might need some planning and design work to get to that point, and that is something that is short-term in nature, so that would be eligible. The closing date will be, sort of after we receive the applications, and I'll walk through the timeline in a slide or two here. The security will be a general obligation of the community. I'll talk about that in just a moment. We will require a local bond counsel opinion for eligible firms. You can refer to our website under the borrowers section. And then in terms of covenants, I mentioned before, you'll have semi-annual repayment, or semi-annual reporting on FEMA reimbursement or insurance payout timeline. And then if you receive funds from either of those sources, they need to be used to pay off this interim loan. And then starting in year 2 of the loan, we will require an annual financial audit. I know that can seem burdensome for some communities, but the bond bank does have relationships with auditors, and we can potentially be helpful in having an auditor work with your community and getting their attention. This is subject to the review of your counsel on the right side here, but this is the expected mechanism by which we think these loans will occur. For many, they already have a current expense note outstanding that was used to take out a bank loan. This could be something like a tax anticipation note or just a current expense note under Vermont statute. You can then refinance that current expense note on a long-term basis without needing a bond vote, and while also benefiting from the community's general obligation by taking out that current expense note and a new note. So we would expect ourselves to be the sort of yellow box on this, but there may be some instances when we would be the current expense note and the long-term debt in select cases. And so the mechanism, what we need to do is create one loan and then essentially refinance that same loan in a year's time. But this is all subject to review by your local counsel. But just high level, that's where we expect most folks will be getting to the general obligation of their community without needing or requiring a bond vote by the full community. Which isn't to say that you won't need governing body approval, etc. I see a Q&A here. Maximum amounts. I'll get to that in just a moment on the maximum amount. So the applications are due by Friday, January 5th. This link to the application is now up on our website at vtbondbank.org/MCRF. You can also, when I send out this presentation, this is hyperlinked to the application. As you'll see on here, we have the overview of the program integrated into the application. We have a pre-application checklist. Everything that is on that checklist you'll need to complete the application, so might as well find out where those are in advance of starting the application. And then, major things that you'll be needing to think about is that we'll want documentation to support the amount of the requests. This could be FEMA project worksheets. We'd like, please have those summarized in one PDF. I know there can be a lot of them. Insurance claims as that documentation may look like, or if it's not insurance or FEMA, please otherwise justify it with documentation, and we'll allow quite a bit of flexibility of what that looks like on your end so that we're not creating any new burdens. And then in terms of revenue losses, we'll just want to see budget to actual, and then the limit would be 10% of the prior year revenue. So we'll document the revenue losses on a budget to actual basis and then compare that against the prior year. The reason we're going to have all the applications come in on a single date is in the event of oversubscription. So we have $15 million to lend, and to the extent we have more than $15 million in applications, we'll be prioritizing them using the following formula, which we're calling the disaster impact ratio. So those will be your documented losses less your insurance payouts plus own source revenue loss divided by your prior operating expenses so that it's scaled for the size of the community. So that gets to the maximum amount question. And I have a question here. Can you include estimated additional cost for repairs that will take place next summer in the application? So because of that potential for oversubscription, we're going to be looking at things that are prospectively, those will be of second priority. Our hope is that, we'll be able to meet demand and there will be sufficient capital for those future needs. But for the time being, this is only expenses that have either occurred, will occur very shortly, and are going to be essentially refinanced through the program. And then there's a question here. Revenue losses can be used to set the loan amount. What about overage on expenses? We expect that overage on expenses would be the costs that those are absolutely eligible. Those would be included in the FEMA eligible cost for public assistance. Presumably those are to do, to the extent that those are associated with flood related expenses, then absolutely those are eligible. So in terms of the invoicing and process here, as well as the integration for eligible communities with the VLCT passive program, this is the way it will work after we sign the loan agreement. The bond bank will invoice borrowers semi-annually, about 45 days prior to the payment date. Included in that invoice will be a certification form that no FEMA reimbursements or insurance proceeds have been received and that you're in compliance with the payoff covenants. And then that will ensure that you're eligible for the VLCT passive interest rate subsidy. The idea being that we don't want to, there's no reason that VLCT passive should have to over subsidize loans if funds are on hand and the loan amount is inflated more than it actually needs to be given the payouts. When the bond bank receives that certification receipt, that will essentially be your voucher to receive the VLCT interest rate subsidy. And we will use that as our documentation to receive the payment from VLCT. So there'd be no cash out on the part of the eligible community. But for those that are not eligible for the VLCT passive program, that invoice will also be your actual invoice for the interest payment up until year 3, in which you'll need to start amortizing principal. So if we don't receive the certification, you'll be on the hook for the interest payment. And it's also your responsibility to keep us informed of any address changes over the course of the loan. Very important that we repay the state in a timely manner. As we said, we're not taking any additional fees or spread here. So the only sources of payment we have to repay the state are those payments from all of you. And then finally, even though there may be a period in which you have no payments on this loan, you will always be on the hook for the payoff of the principal amount and the amortization of the principal amount starting in year 3. So I didn't include it in here, but I will add this. Basic timeline for the program is that the applications are due on January 5th. We will review those and take those to our board for approval around January 29th. We are in discussions with the state on the form of our loan agreement with the state, but we expect or hope that that will be completed around the end of January, which would allow us to fund the loans shortly thereafter, like maybe first couple weeks of February. But I didn't put a hard deadline on that because we don't have the agreement in hand, but that's our expectation anyway. Um, so a couple of questions here. And there's our contact information. Feel free to reach out to any of us, in particular Ken Lingy, our loan officer, who has been in contact with many of you to date on the development of this program and your flood-related expenses generally. Couple questions here. Do we need to have our current expense note in place before January 5th? What we can do, if you'd like I said, we will explore direct reimbursement. So it could be that your current expense note is actually with the bond bank, if you don't have one already. And given where we are in relationship to January 5th, that'd probably be the right call. We'll just need you to spell that out in your application for us. And then for another question here, non-FEMA eligible expenses that have resulted in expenses above and beyond what was budgeted. So long as those are flood related, they're absolutely eligible to be refinanced through the program. Yeah, Carol, this is Carol's questions. These are all eligible, Carol. We would expect no problem on those. And in fact, that's exactly the thing we're happy to provide is flexibility or a sweep up of things that aren't otherwise FEMA eligible. There's a question here. What is the bond level threshold for this program? Do towns need to have voter approval? Just want to go back to the graphic on the right side here. So the mechanism you would use, we've said $100,000, which is we think an amount that makes sense. If you have a specific liquidity need in your budget, meaning you need cash on hand that is less than $100,000, reach out to us and let us know those unique circumstances. But generally, we think $100,000 or more is the appropriate amount. You won't need voter approval if you're using the following mechanism: a current expense note for these unanticipated expenses. And then that current expense note within or at the end of 1 year would be refinanced into long-term debt. So it may be the case that we're working with you to do both note one and note two, or it may be the case that you, through note one, is funded with a local bank, and then we're providing note two as shown on the screen. But you're going to want to work with local bond counsel. And again, those names of those firms that are sort of pre-qualified are up on our website under the borrowers tab. And those are all firms that you probably are already familiar with, do a lot of work around the state. It's not a requirement that a town already have a professional audit to be eligible to apply. So self-prepared financial statements can be submitted alongside the application. We just ask that we have 3 years of statements, even if they're self-prepared or not or have not been audited by a third party. Confirm that we wouldn't need a vote to convert a current expense note to long-term debt. That's been what's communicated to me from the local bond counsel community. But again, you're going to want to clarify that and confirm that with counsel. The principal amortization is at year 3. So you have 2 years interest only, and then 5 years of amortization for a total term of 7 years. What documentation do you need for non-FEMA eligible expenses? We'd want to see the vendor invoices or summaries thereof, something to that nature. It will allow you to tell us what is the easiest way to submit that documentation so we aren't creating a new burden on you. Yes, this webinar is recorded. And how can I see everyone else's questions? I have been reading them aloud. And I'll try and get these in the chat before the end of the meeting so people can see them. Let's see. Last question here. Did you say that there's only 15 million available? Yes, that is correct. So again, we're going to use that allocation methodology that I described at the bottom of this slide to, in the event that there are more than $15 million in requests that come in the door. And listen, if we find that we've got $40 million of demand, we'll start thinking through potential options. But for the moment, this was an amount that the bond bank could absorb, and that was available through the 10% in Vermont program. But obviously, we're going to be doing everything we can, as we have over the last 4 or 5 months, to help communities that need help. Slides will be on our website in an hour or two here. Mobile home owners eligible? No, this is just for municipalities. The bond bank only has lending authority to units of government. Another question here. To document non-FEMA eligible expenses, can work plans for road work to take place in 2024 be counted? If you've spent the money already and it's documented in that way, then that would be acceptable. We are focusing in on expenses that have already been occurred or will occur imminently as our first priority for these funds. But if you have upcoming expenses, let us know because we can look at options through the bond bank's other programs to find the most appropriate source of capital. So that'd be a great reason to reach out sooner rather than later to Ken or myself to begin discussing options and the specifics of your program. This is definitely a soft application. Contact us as much as possible. We just want to have an application to get all the documentation down in one spot. Oops. Feel free to raise your hand. Put it in the chat here. I have another question here. Repairs have to be done in 2024 due to weather. Cost and bids are in. Can they be included? Again, I think that long-term capital is most appropriate for other sources, but there may be a portion of those expenses, like, for example, engineering work or design or other design work that may have taken place that we might be able to consider for the program. But please reach out to us and let's discuss the specifics of your need. Okay. Well, that was pretty efficient. Need any more Q&A? Oh, Carol, I'm gonna allow you to talk.
There are a lot of people who would like to have that power. Is there any thought about making the application due date even a week later or even a couple days later? I'm just thinking we're right into the holidays. We've got a lot of staff time off between now and then, and trying to fit this in might be difficult.
Yeah, well, yeah. I mean, our constraint is that we have our just to be like we're amongst friends here. We have our pooled loan program applications for those are going to be reviewed over the course of January and submitted to our board at the end of the month. And then we're going to be trying to review these as possible and be equitable on how we allocate funds. So we have a little bit of a timing issue, but Carol, what do you think would be helpful understanding that, yeah, we couldn't be much longer than about a week after what we've described here?
Even if it was the following Monday, so that it gave us the weekend to complete applications, that would give a little breathing room. I'm thinking this is the first time I've ever taken the week off of Christmas, and I'm not in the office until the 2nd, and to have a little bit of breathing room would be nice.
Yeah, okay. So how about Wednesday the 10th?
I love it.
All right. Your wish is you definitely deserve some time off, Carol, and all of you do. So no problem on our end. We we want to do this right. We want to make sure we have enough time to consider every application, every need. So so I guess with that in mind, if you can get it in earlier, please do. But we want to evaluate all of the applications at one time so that we can, equitably distribute the money we have.
Thank you.
You're welcome, Carol. No problem. Let me, I think I'm missing a question here, so let me figure out where the Q&A button went. Lisa, reach out to us. Let us know what you have that we might be able to rely on to verify the expenses. Lisa's got a question. I don't have my projects to be written up by the application deadline. What else can we provide for documents? Let's talk through that offline. So please reach out to Ken with your, unique circumstances. Eric, we got you covered there. Wednesday, January 10th will be the date. I will update this presentation with that date so it's clear to everyone, and that'll be updated on our website, like I said. Any other questions from the crowd here? Okay, good. Well, thanks for everybody for joining today. Appreciate you making the time. And like I said, I just want to reiterate, this is intended to be a collaborative program where the whole point is to help out municipalities in Vermont and provide relief. So we can't do that if we aren't learning from you about conditions on the ground. And thanks for your support in developing this program over the last couple months. And we're really excited to be, getting these funds out and getting them where they're going to be most useful in your hands. So with that, I will end the webinar and thank you all again. Talk to you soon.